Hey, Steve here, and in this video I want to talk to you about Nadex Spreads. This isn't something that I trade a whole lot, but I know a lot of people asked about it, so hopefully this will be a simple way to explain Nadex Spreads. So log in. Again, this demo account, Forex spreads, we're going to look at. They do have Indc Spreads and commodity spreads. They're all a little bit different in the sense of pricing and so forth, but we're going to just walk you through the Euro-US dollar spreads. So Euro US dollar Forex spreads, we're going to look at the 7 to 3 p.m. Option. And there's three different options here. In different ones, if I click on the dailies, they give you four different options. And if I do 12 to 2, it's two different options and so forth. But in this example, hopefully it'll kind of show you how exactly it works. So you can see the indicative price, 106.69. We'll drop that last digit there, but 106.69 is where the market is. And then you have the bid, which is the sell side, so 106.67, and then the offer side is 106.71. So about 2 pips in either direction is your spread for this particular contract, and it expires at 3 p.m. Now, we're going to, in this example, click on the buy side, and then we'll show a sell side later in the video as well. But if I click on the ticket on the offer side, the buy side, the ticket will pop up, and we will do this. We will hit a size, and we're going to just make this easy for us so we get filled. So we're going to change it to 73 a second. But you can see that this is the floor. The floor is 105.15 and the ceiling is 107.65. So they call that the floor and the ceiling. So the contract on the Euro US dollar for this one is between 105.15 and 107.65. Now, so and we're going to buy it. So let's say the market falls all the way to 104, 1.0400. We would not lose 260 or 270 pips. We would actually only lose from 106.73 to 105.15. So, 158 pips. Is what we would lose. Now our max profit, now if this went all the way up to 108, so 1.0800, we would not get all the profit all the way to 101.08. We would only make it up to 107.65. So in that case, about 92 pips is our max profit. And our max loss again is 158. Now again, if you change size, if you want to do 2 contracts, 10 contracts, etc., it's going to change your max loss and max profit and so forth. So some of the advantages to spreads that some people like, again, I tend to trade binary options. I like that more, is it limits your risk. So if in case there's a massive move downward or upward, depending on which way you're trading, it's going to limit how much risk you have. So you will not be at risk for any more than that $158. So let's say there was a massive news event and you lost a trade. In a Forex market, if the stops weren't taken out and so forth, you'd be more responsible for that. In this spreads, your max loss is $158. So if this went all the way down to 99, you're still at risk for only $158. So since I've been talking, the market has moved a little bit. So it's $1 a pip. So if this moved up $1, you would get $1 for every pip that it moved above the number. So we're trying to buy it at 73. We're going to change it since the market moved to 75, just so I get filled for this particular video. And you can see that it's right here on the top here. I have some other trades going on, but you can see it's at the top here of 105.59, or excuse me, 105.15 to 107.65. I paid 106.75 for it, and the current market, if I wanted to exit, is 106.72. So let's say that we just left it for the whole time till 3 o'clock. If this closed at 106.80, we would make $5 for that particular thing. So it would say $5 of profit there. If this closed at 106.70, we would have a $5 loss. Now, so some of the advantages and disadvantages. So in spread, an advantage is if you lose a trade by a couple of pips, you only lost a couple of bucks times however many contracts you had. In binary options, if you lost a trade by a couple of pips, you lost whatever you invested in the binary option. So if it was $50, it was $50. The other thing is in binary options, if you win the trade by 60 points or 60 pips, it doesn't matter if you won by 60 pips or 1 pip, your payout is going to be the exact same. In spreads, if you won the trade by 6 pips, you're only going to make $6. But if you won it by 60 pips, you're going to make $60 times however many contracts. So the spreads is the easiest way that I describe it is spreads at Nadex is a lot like trading the regular Forex market with a Forex broker and so forth. It's not exactly the same, but there's a lot of similarities. Now you cannot have stops at Nadex, so you cannot place a stop, but you can place a profit target. So if I thought, okay, I think the market will hit 106.90, I can click on the open position here. The ticket will pop up, and I can place my working order at 106.90 and just change these two numbers here and hit place order, and it will show up in my working orders as working. So in this case, if that trade hits, if it hits 106.90, I would end up with $15 of profit. So the difference between 106.75 and 106.90. So I'd have $15 profit in that case. So it's a lot like that in the Forex market as well. The difference is no matter which currency pair you trade at Nadex, it's always $1 per pip. So in the Forex market, the Euro US dollar is worth, whatever, $1 per pip. But then the Australian US dollar is worth 80 cents per pip or whatever the case is. That's for micro lots and so forth. So, and the other aspects is margin. So in this particular case, the margin or the amount I had to outlay was $158. That's probably a little more or a little less in the Forex market. So you can't have stops in Nadex futures, or excuse me, Nadex spreads, but you can have profit targets and you can limit your risk. So I'll show you a sell trade here in a second, but I'll also show you you can trade, even limit your risk even more so here, and I'll show you that in a second. So I want to show you how to even limit your risk even more. So I changed it to the Euro US dollar spreads 12-2, and in this case they have a floor and a ceiling here, but the ceiling or the floor here is 106.70, and the market, as you can see, is 106.71 right now. But if I wanted to buy this contract, I have to buy it for 106.81. So I'm buying it for about a 9.9 pip spread, or 9 pips out of the money. So why would you do that is the question. Well, if I click on offer and the ticket pops up, the reason for that would be this. And I'm going to put one contract in here for you in a second. And you can see here on the max loss, which again is how much they're going to take out of my account, it's $11, and my max profit is $89. So my max profit is 8 times what my max loss is, which is fantastic. So if, for example, something is bouncing around a resistance or a support line or whatever the case is, and you think, okay, I think it's going to bounce, but just in case, I don't want to risk a whole bunch, because if it breaks that support, it's going to fall tremendously, and I got a huge risk. So, but if it does bounce, it could go up 40, 50 points. So that would be a way to do it. So you're limiting your risk to $11 in this particular case, even though you're having to pay, $8 or 8 pips out of the money. So let's say I buy this. Let me see. Let me get filled a second. Make sure I get filled. Okay, you can see the trade here, the 106.70 versus the 106.70 or 107.70, and I paid 106.82 for it. Current market is 79, which means that's what I could sell the position for, which I would take a $3 loss on. And but the indicative is 106.75, and that's the important one. So so let's say at 2 o'clock this closes at 106.80. Okay, I would only lose 2 pips because I bought it for 106.82. So I would lose 2 pips on that particular trade. Now if it went up to 107 flat, I would make 18 pips, even though that's actually about 24 pips from where the current market is. So what matters is this indicative as it gets closer to the expiration time. So again, and then the benefit is if this went down to 106.65, I would not be at risk for that full amount. I'm only at risk to 106.70. So my max risk on this particular trade was that I think I paid $12 for it. So if this thing crashes, like I said in the example, where you think it's gonna bounce off the support, but if it doesn't bounce off support, it's gonna go down 50 pips. This is your way to limit your risk on that side, and then have a larger gain on the upside if that works. So that's some of the reasons that some people like to do spreads in that sense. And again, in this case, it cost me $11. And if I'm wrong, and this closes at 106.75, I lost $7, and the market didn't go. And if it closed at 106.90, I made $8 on the thing. So, and then you can scale it up based on how many contracts and so forth that you want. So that's a little bit about trading out of the money, limiting your risk on spreads as well. Now I'm not going to go over that in the opposite direction, because you can do that in the opposite direction as well. So if you were thinking you wanted to sell the position, you think the market is going to go down, you could take this 106.63, which is 14 pips out of the money, but again your risk would only be about $7 in that particular case. But I will show you how to sell on a spread trade now. So we're going to go to a different thing just to show you a little different look. So we're going to look at the Indc Spreads, and we'll look at the Wall Street 30, which is the Dow Jones, and we'll look at the 8 to 415. And you can see the market is at 19,166, 165. Again, I can sell the middle one is usually the one that's going to be the most accurate, in the sense that it's going to be closest to the indicative. So whether there's 3 listed there or 5 listed there, look to the middle one, because the other ones are going to be far in the money or far out of the money kind of trades. So we're going to just look at the one that's right near the money, just to show you how to place this trade. So this is the 19,000 versus the 19,300. Those are the floor and the ceiling. So that's the floor. If it goes lower than 19,000, you're not at risk for that. If it goes above the 19,300, you're not at risk for that. So so we're going to click on it. Again, this is sell position, so we want to click on the red. So ticket will pop up, and it will tell us how much our max loss and max gain is. So it's almost 50-50. If this was priced at 19,150, it would be 150 loss, 150 profit on this particular case. So that is basically $1 per point here on the Wall Street as well. So so if this goes down, for every point it goes down, you're going to make $1. For every point it goes up, you're going to lose $1 since we're selling this position. So I'm going to go ahead and sell it. And the market just moved on me. I don't know why I moved it to 62, but let me put up the working order a minute and change that a second. Let's move that down to 60 so I get filled. Ugh, market moved on me again. All right, well, it's not going to move on me this much, so I'm going to put 19,140 in there. Oh, I got filled. Anyway, so I got filled at 19,160. So you can see it's 19,160. The market's currently at 19,166. So I would exit this position right now. I would lose $6 on the trade. Tells me position value and tells me the indicative. So if the indicative again at 415 is below 19,160, I'm going to make some money. If it's above the 19,160, I'm going to lose money. So in this case, if this is where it closed at 415, I would lose about $2, $3 on this particular trade. So you're having to outlay some more money for a bit smaller return on investment versus binary options. But you know, if you're wrong by a little bit, it doesn't cost you as much. If you're right by a little bit, you know, you don't do as well as you would do in binary options. So there's lots of different ways to trade it. That's just a little snapshot of spreads. Again, there's lots of different ways to trade it. In my opinion, if the trade is going to win by a small amount, binary options is the way to go. If a trade is going to lose by a big amount, binary options is the way to go. If the trade is going to win by a big amount, spreads would be a better way to go, in the sense that you'll make more pips. And if it's going to lose by a small amount, spreads is the way to go. So obviously you don't know those things ahead of time, but you know, have your trading plan. And I don't trade spreads all that often. I trade binary options. I prefer binary options. So it's not like you have to trade spreads. Don't feel like you have to trade spreads. I have many people who only focus on one particular instrument, one particular time frames, and so forth, and they still do very well. So if you need to contact me, do so on YouTube here. You can get a free system of mine at MrBinaryOptions.com/free. Subscribe to the channel. I have a lot of videos here about Nadex and other trading things. Lastly, let me get out of one of these trades. I don't think I've done that here in the spreads. If you ever need to get out of a trade, let's say you don't like this Wall Street trade anymore, just click on it in your open positions. A ticket will pop up. It'll pop up in the opposite direction of your particular order. So this particular case, I had a sell position, so you can see it's highlighted blue, and they automatically filled in the price there. I just hit place order, and you can see that I'm no longer in that position. So there you go. Again, feel free to contact me with any questions. Hope you enjoyed. Take care.